Good evening. My name is TK Kugler. Thank you all for coming to the Wasabi Venture Stallions Fund 7 kickoff. At some level, it's amazing that this is Fund 7. I see a couple names on here on our list here of people who have been investors in all seven funds as well, which is a great sign, and hopefully that's a testament that we're doing things that or the first six funds that we're doing things that people are really happy about. So let's jump in and talk about what this fund's about, and how it makes sense for all of you or not, for that matter. Um, so right off, there's a legal disclaimer, and I usually don't spend much time talking about legal disclaimers, but I do here, just because so much in horse racing, in my opinion, is not an investment. Okay. What I will tell you is that what you're going to hear tonight about Wasabi Ventures Stallions and our Fund 7 is it's an investment. And like all investments, there's a legal disclaimer, right? Past performance is no indication of future, blah, blah, blah. All the things that you've heard a million times, they're written in here. But the key message to take away here is this is an investment vehicle. We built it to be an investment vehicle. It is regulated by the SEC. We are registered with the SEC. So it is truly an investment vehicle. What's the team? Once again, I've introduced myself. I'd like to think I am sort of the business creator here, but the real brains of the bloodstock and management of the assets in many ways is our man George Adams. George is on the call, just joined, and there he is. He's waving to all of you. So George is really the brains behind the operation. I am the pretty face, as I'd like to say. So what is this? What are we talking about? So this is for those of you who don't know me. I have spent all of my adult life in sort of the startup venture capital world, private equity world. I've done that. I built my first company at 15, and I've really done nothing else but that. Now that I'm an old grayed man, I've done that my whole life. So when I got into horse racing and really started to learn about it, I said, "Wow, there's a real opportunity here to build some of the things that happen in venture capital and bring them over to horse racing." I saw real opportunities. So, really, probably 8 years ago, I decided to build Wasabi Venture Stallions, which is a venture capital style alternative asset fund where all of the assets are thoroughbred breeding assets. It's very important to understand we are not a racing operation. This is as although racing obviously is the byproduct of thoroughbred breeding, we are the assets themselves, and we'll talk about this tonight. We don't have racehorses in any of our assets, or rarely have racehorses in any of our assets. And if we do, it's only because they're going to become stallions very soon. This is a thoroughbred breeding asset fund. Um, a little quote from BlackRock, especially in unknown times, there's a reason why accredited investors and wealthy family offices are diverting more and more of their assets to alternative assets. And this little quote from BlackRock talks about that. We are an alternative asset class. That's what we are. We're not a public. This is not public stocks. This is not. You're not buying Nvidia here. This is very similar. If you there are alternative asset funds out there for art or for collectible cars, farmland, all of those things. Those would be alternative assets, and we are in that class of funds. So, what are thoroughbred breeding assets? There's really four shares of stallions. So, in this case, think of a stallion as a company, and there are 40, 60, or 80 shares. depending on sometimes 50, I suppose. Historically, it's been 40. But you can buy a share of that stallion just like you would a company. Um, Lifetime breeding rights in stallions. This is not something we tend to do very much anymore. Our earlier funds had a lot of lifetime breeding rights, mostly because the market has moved away from lifetime breeding rights in many ways, and we've also moved away. But I put it on there because it is an asset that can exist. Full ownership of a stallion. We buy the whole stallion. Or a very large aspect of it, maybe with a partner, and we split that up. That could happen in Fund 7. It has not happened in the first 6 funds, just so we're clear, but it's not impossible that I could see it happening in Fund 7 as our funds especially get larger and larger. And then the last thing is broodmare ownership. Uh, Funds 4 through 6, 4, 5, and 6. I'm sorry, 3, 4, 5, and 6 all have broodmares in them. Funds 1 and 2 did not, mostly because they were smaller funds, and so we had to wait until the funds are a little larger. And we'll talk about why all of these are and what they are. But a broodmare is the female aspect for those of you who are brand new to thoroughbred breeding, or you didn't get your full take on the birds and the bees at some point. The brood mares are the female aspect. The stallions are the male aspect of the breeding. So, how these assets earn a return. Uh, for some of you who are brand new to thoroughbred on the breeding side, some of what I'm going to tell you here is probably going to be very interesting. You've probably never heard some of these things before. Um, and if you're just so if you were an investor in other sort of alternative asset classes, I may make a couple analogies here to try to tie things together. But thoroughbred breeding and the way it generates revenue for the investors is a little unique. Shares of stallions. Really, three main ways that they earn money. They get an annual dividend. This is sometimes called a shared pool or stallion bonus, just like a company who earns money. So the way a stallion works, by and large, if you're not familiar with the asset class at all, is that a stallion will stand. He'll retire from racing. He'll stand and he'll go to a stallion farm. And each year, a broodmare owner will send their broodmare to that stallion so that he covers her and produces a foal. 11 months later, it produces a foal. It's an 11-month gestation period. When that foal, by and large, when that foal is born, the stallion owner gets paid a what's known as a stand-in nursing fee. So once that foal stands up, nurses with its mom, officially that broodmare owner owes the stallion a fee, and those fees can range everything from $1,000 to $500,000 and everything in between, depending on the stallion. That all of those revenues go into a pool, and then there's a distribution or a dividend. That's what I'm talking about with A. The sale of the season. This is one that is very, very unique. The first A makes a lot of sense. It's just like a stock dividend, if you will. But when you buy a share of a stallion, you actually get a season. Think of it almost as a coupon bond. You get a coupon, and that coupon allows you a breeding to that stallion per year. Now, you can use that with your own broodmare, or you can sell it just like you would a coupon bond. You could also turn it into the pool and get a larger dividend. There's aspects of it, but generally speaking, you got a coupon, and you can sometimes have one season on a when you own a share of a stallion, sometimes two. Sometimes you can have four. Sometimes you can have unlimited. It just depends on what the operating agreement of that stallion is. But generally speaking, you at least have one every year, and you could sell that, and then that also generates revenue. And like any other asset, it can get sold. Um, so lifetime breeding rights, very similar, except that you don't have that dividend because you don't actually own the stallion. Or a piece of the stallion. What you have is the right, just like it sounds like, for the life of that stallion, as long as it's standing at the farm that it's at, you have the right to use one of those coupons. That's what it says. And once again, you can sell that coupon. Once again, depends on the operating agreement and things like that. But it acts in many, many ways. And so LBRs are just like stallion shares, except that there's none of that annual dividend. You also can't, when the stallion gets sold, you often don't get anything as a lifetime breeding right. Sometimes you get a token amount, but generally speaking, you don't. You can, though, sell your lifetime breeding right at some point in the future, just like an asset in itself. But if the stallion himself gets sold, you're not getting much of anything. Broodmare ownership, if you own the female side of it, you get money when that broodmare sells. I'm sorry, when that broodmare has a foal and you sell that foal. You can also partially sell a broodmare, right? And we do that. As a matter of fact, we often, when we buy a broodmare, we'll sell 20% chunks of it right away, and that's do as kind of a hedge, so that we're not owning the whole broodmare. And you can obviously sell the broodmare just like any other asset. And we're going to talk a little bit about that coming up here in a couple case studies. So those are the three ways that the assets make, or the three main classifications and how they make money. And once again, if you have any questions, feel free to put them in the chat and I will get back to them. So when does a fund generally earn returns? So what we're going to talk about the structure of the fund, but it's a 10-year fund. So fund 7, we're in year 0 right now. The first year, we raise the money, we deploy that money, meaning we buy the assets. Next year is when things can start to earn money. And this heat chart, if you will, I put it in here just so, and I put some colors. The brighter the color of orange, orange is my favorite color, which is why you might ask why there's a lot of orange in all of our logos and things like that. But orange is my favorite color. The brighter the orange, the more likely it is and the more intense returns should be in a particular year. And if you'll notice, obviously you're usually not selling, like if you look at the line on liquidity of an event of an asset, we're not selling, generally speaking, an asset we just bought in year 1, right? That does, I mean, it could happen, and it has happened a couple times actually for us. But generally speaking, it doesn't. So it's the intensity is in the later part of the fund. What you should take away from this chart is that it's a 10-year fund, and that the early years, broodmares have a better potential for earning some of that return. Okay. It's just the nature of sort of how that is. Although, with the one exception of year 2 for stallion shares, a freshman stallion usually earns about 25 to 30% of its whole value back the very first cycle. So that's in year 2, right? So if you remember from the foaling out discussion that we had earlier. So a lot of the intensity of the orange is later in the fund. Year 6, 7, 8, 9, and 10 are really what you're talking about. You'll hear me talk a lot about the J curve. A J curve is a very well known sort of scientific financial measurement that discusses how long it takes for a fund to start earning positive income. Most funds have a dip and then they go up in the private equity world, right? It dips as you're deploying capital, and then it hits a bottom, and then it starts going back up. The shorter you can make that J curve, the better. So the shallower it is, because then you're not going super negative. Many private equity funds, it takes 3 and 4 years and 5 years before you start getting returns. We'll talk about how our funds don't really work that way. This asset class doesn't work that way. It tends to happen earlier to start to get a trickle of returns. And so the J curve tends to be shallower. We try to drive it that way, and then trying to get to that sharp J point as soon as you can. But that's sort of what the J curve is. We have a great video that talks in detail about the J curve. Feel free to look on our YouTube channel and dig into it. How is this fund structured? It's a Delaware Series LLC fund. You will get a K1. Our K1s, just personally, I get almost 200 K1s a year. That's what I personally get. I can tell you, I don't get a lot of those K1s until the middle of the summer. I have not filed taxes on April 15th since I was 17 years old. So I'm always an October 15th kind of guy. But our team works extremely hard, and believe it or not, we are already sending K1s out this year. So within the next 2 weeks or so, I would expect all the K1s for all of the first six funds to be distributed, which is, I will tell you, as a guy who spent his whole life in the private equity sort of world, that's a miracle. That's just a testament to some great work by our team. But you get a K1 is the story. It's an annual fund with distinct assets. What that means is the assets that are in Fund 7 are not in funds 1 through 6, generally speaking, right? They're new assets. So the performance of Fund 2 does not directly impact the performance of Fund 7. Now, of course, there's gained knowledge and historical understanding of the marketplace and all that stuff that happens. But the assets are distinct. Each fund, it is a 10-year fund. We talked about that. And it's a 2 and 20 fund. And what does that mean? That means we charge a 2% management fee and we get a 20% carry on it. Kind of the sort of standard numbers that you sort of see in the private equity world. I've seen worse. I haven't seen much higher, as a matter of fact. It's only marketed and available to US-based accredited and qualified investors. That's the law. I hope someday that law changes, but I can tell you right now that is the law. Um, this one bullet, and once again, everything that I'm telling you here, if you were an investor in any of the last 3 or 4 or 5 funds that we've had, everything is identical except for this next line. It's a $5,000 minimum investment for the first 30 days. After 30 days, we up that to $10,000 minimum. The one thing that is new with this fund is we are going to a $500,000 maximum. We have 2 or 3 investors where their minimum investment that they can make is a $500,000, and I'd like them to join the fund. So we historically we've been capped at $250,000. We moved it to a $500,000 this year. I should also mention, by law, we are only allowed to have 100 investors total. That's the law. We can't change it. So when we hit 100 investors, we're done. We're targeting between a million and 2.5 million. If a couple of the investors that I've talked to come in, the number could be much, much higher, to be honest with you. But that's the minimum target that we're kind of looking at, just so you are aware. Fundraising will go through the end of October. It will open tomorrow morning. Tomorrow morning, you'll get a notification. You can log into the portal. Everything happens in the portal, and you can make your commitment right then. And it all happens online, just like it has for everyone since the time we started. How did Wasabi Venture Stallion started? It all started with some magic from George Adams, and the magic was a horse named Force the Pass. We bought a stallion in September 2019 for $100,000. We stood him in Maryland for 1 year. To the day. If there is anything that is miraculous, we literally bought them on one day in September, and 1 year to the exact day, we sold him for a $500,000, yielding the 3.69x return for the investors. We decided to take all of that success that we gained and said, we're launching a fund. I had come up with the concept of a fund, went through the legal steps that we had to make, the regulatory steps, and we created our series in 2020. We paid out our first distributions on Fund 1 in June 2022. Every fund that we have launched since then, obviously not last year's fund because it's just starting year 1 here, but the first 5 funds have all had distributions already, and we'll talk about that in a second. I should also mention that Force the Pass is still paying off dividends to people who, and some of which are on this call because they've been investors way with us even before we had funds. He kicked out $20,000 in dividends just this year, just this past year, to those investors. Why? Because there are things called stallion bonuses that happen in regional stallions, and he earned about $20,000 in stallion bonuses, I believe. So they're still getting dividends. They just got a dividend. We just got a dividend check within the last couple of weeks on it. So he's still making money for the folks who invested in him way back in 2019. So things to understand. J curve is shallow, but it does affect that first 18, 30 months because you got to invest and deploy the capital and start having years one, two, and three can still give you significant distributions. We'll talk about that. The best years should be 6 through 10. Distributions happen twice per year. We do one in Q1. I should say, be very crystal clear. We target to do distributions once or twice per year, either Q1 and then either June or July. Most of that has to do with how stallion and breeding assets, when they earn their money. There's a big chunk that happens at the end of the years for brood mares, and stallions tend to earn their money in the first half of a year. So it makes sense that those are the two areas when we do distributions. We like to think about DPI. That's distributions per investment. It's our biggest metric. We are trying to get money back, even though it's a 10-year fund, even though you can't come take your money back out. We are a closed fund. Once you put your investment in, it's with us for a decade. But we try to get distributions back as soon as we can. As soon as we start earning money, we start to get money back to you. And like I said, we have done every fund has gotten distributions. Funds 1 through 5 have already started to earn distributions, and in some cases, a lot of distributions, which we'll talk about in a second. But DPI is our number one focus and our number one metric. Get money back to investors, make that J curve as shallow as possible. So, how have funds 1 through 4 performed? Once again, Fund 1 was from 2020. That was the first year. We have returned 73.2% of the money already for Fund 1. That's 18.3% per year that is earned. And you can see the numbers straight across. The Fund 4 has already distributed, and it just had its first full 1 year cycle, which is why it's on here. But it has returned almost 1/5 of the money in the very first year cycle. We're going to talk about a case study of a particular asset and why some of that happened, by the way. But you can see the numbers we're very proud of these numbers, is what I would say. And you can see in Fund 1 is on a trajectory where it hopefully by year 6, it's at 100%, and those last 4 years are where you start to get the gravy. The other thing, and this is candidly, I will be very honest with you, this is one of the biggest reasons why large investors are coming to Wasabi Venture Stallions. Besides the great asset class and the DPI that we performed, the change in depreciation from the one big beautiful bill has made our asset class extremely exciting for many investors. While I cannot give you tax advice and I cannot tell you how this impacts your personal taxes, it's not my job, and I definitely won't do that. What I can tell you is what's going to be on your K1, which is in the very first year that you invest. If you invest in Fund 7, almost all of the money that you invest is going to show up as a passive negative in your first K1 that you get. What you do with that negative and how you treat that passive negative is for you and your tax accountants to figure out. But I can tell you it is an unbelievable benefit. As the single largest investor in all of these funds, I can tell you I get dollar for dollar off of my income from the one big beautiful bill. And because it's accelerated depreciation, it's part of the bill that came across so that 100% of what because all of our assets, generally speaking, I want to be very careful with my language, but generally speaking, when we invest and buy a stallion share, that stallion share that first year is fully depreciable in accelerated bonus, sometimes called bonus depreciation. That gets passed on to investors via the K1. So that is drawing a lot of attention from investors for sure. So I'm going to talk about quickly two case studies. First one is a stallion that we own a share of called Honest Mischief, stands in New York, and great case study about sort of how an asset can earn money here. I won't read line for line here, but we basically in year zero it cost us $10,000 to buy the stallion. The stallion, because it's a share, you have your prorated amount of expenses, and that's the negative that you see there. It costs about $2,500 to have a share of a stallion in New York for a year. But then you sell. We generated a great deal of revenue, and this stallion in particular has, for lack of a better word, hit. He is now easily, George. I don't, you're the bloodstock expert, but easily one of the three most promising and valuable New York-based stallions at this point.
Oh, for sure. Probably two, given the age of one of those other sort of top three horses in New York. He's got a fairly limited lifespan left to him, whereas Honest Mistress just kicking off. But yes, definitely going to be at the top for a long time in New York.
Yep. And you could see projected years 5 and 6, the income that we're expecting from them. And that's all from a $10,000 investment. So the numbers are looking very good. And once again, as George pointed out, he's just beginning his career. This could go on for 15 years. The one thing that it's really worth notice, private shares of him have been selling for $20,000. So even if we wanted to, we could liquidate him today, liquidate our share, not him, but liquidate our share of him, and double our money, including plus all the money we've already made off of his seasons and his bonus money. So really quite exciting. It's a great demonstration of uh, of how a regional stallion. We don't have many regional stallions. Most of everything we have is Kentucky based, but this is one of those ones where a regional stallion, when you hit, you hit. We have one regional stallion, Arzak, which is in Fund 6. That's one from last year. Very similar story to Honest Mischief. We're trying to catch the lightning in the bottle again there. Um, the next one that I want to talk about is actually a broodmare, and I picked a stallion share so you can kind of see what that feels like. And now I'm picking a broodmare asset for you. This is a broodmare we paid $80,000 for in November of 2023. It's in Fund 4. We sold 40% of it as sort of a, once again, remember I talked about, so we sold the day we bought it, we sold 40%. So we retained 60% of that stallion, of that the broodmare. We also eliminated 40% of the carrying costs because of that as well. Um, so as we did that, we had two this year, a 2024 Practical Joke and a 2025 Gun Night sell. The latter one was the session topper at $160,000 in November of Keeneland in the year that it just happened, 2025. So November of 2025, you can see all of the income. You can see how this broodmare now is positive very, very quickly. Remember, we talked about flattening that J curve. This is how broodmares flatten the J curve. When you get a broodmare that works and the numbers work, it flattens that J curve and starts getting money right back to the investors very quickly. This broodmare just checked into locked. It's one of the first three broodmares in the world who is in foal to Locked, freshman stallion Locked, who we also in Fund 4 own a share of. So we also own a fund. We also own Locked as well. Um, so we're hopeful, has a great, healthy, Locked baby, and that one sells for $250,000 plus. That would be a fantastic story. And now you can see how a broodmare earns income for the fund. Um, so what's Fund Seven's target mix? Now, once again, we do not have a single stallion asset yet in Fund Seven. We're raising capital now. Um, and honestly, there are no stallion assets to add. They tend to get added later in the year. So it's very possible that you have to make your investment before we have the stallions announced. That's just how this goes. You're buying into the concept of the asset class, not particular assets. You're buying into a fund. So 30 to 35% is going to be broodmare, 65 to 70% stallion asset. We really try to keep it very stallion heavy. There's a reason, because that the broodmares have a carrying cost. You try to keep that down to a minimum. The stallions have a much lighter carrying cost, and it just makes more sense from a fund structure. We can't promise that this will be the mix, because you never know what the market will hold, but I'm fairly certain we're going to be in this ballpark. Okay. And once again, Fund 7 launches tomorrow. So tomorrow morning, you'll be able to make your investment. Once again, I just want to remind you, one thing I should remind you, once again, everything is the same as last year, except we did up the maximum. Um, just one thing to sort of keep in mind is that if you are doing the $5,000 minimum in the first 30 days, you also have to fund your investment in the first 30 days if you're just doing 5,000. You can always increase your investment later in the year if you want. We have investors who do that all the time, who say, I'm in for five. I know I'm going to do at least five. And then later in the year, they decide to add more to it. You can do that, but you do have to do your funding in the first 30 days as well. Not only make a commitment, but fund. Most investors, candidly, historically, the minute that they make a commitment, they fund, and then it's sort of out of the way for them. But that's I just want to remind you that that's the case. I also want to remind you that we are capped at 100 people this year, or 100 entities, just to be clear. People can invest as a trust, or they can invest as a corporation. Any of those are possible too. You don't have to invest as an individual. Um, so we have both of those cases as well that take place. But just to remind you, we are capped at 100 entities. I would expect in the first 30 days we will be 50 or 60 already committed. So we will be halfway done in the first 30 days. So if you're gonna do this, let's do this. Is what no pressure, but I just want to have you, even though we'll leave it open until we get to 100 or October, whichever happens first. But that's kind of the story. Any questions? If you have a question, feel free to put it in the chat. I'm happy to answer any of those. Check the chat. We have no questions yet. So I'm certain, given I already had, I just anecdotally, just so everyone knows, I have already had soft commitments from three people who are putting in six figures into this fund. So I am certain this will be our largest fund we've ever had. The one big beautiful bill for investors has been a big thing for them. The tax benefit is one of those things that a lot of people are gravitating to this asset class for. All right. Well, thank you all for coming tonight. You'll get a notification that the fund is open tomorrow. This recording will also be posted. This deck will also be available, and we have some other sort of stuff that's available as well, around, including all of documents like a PPM and those things that go along with the fund. But all of those will be available tomorrow morning. So just make sure you sign into the portal. We got a question. Since these are 10-year funds, what happens if there are still productive assets at the end of year 10? Great question, Todd. Um, the PPM gives us some flexibility to leave it open. If it's good, we can also sell the assets at the end of a fund. If you get to the end of the 10 years, what the 10 years does is it caps, we will never charge another management fee. So we don't get any more 2%. It's just on us. I think it's also important, if you've been an investor in other funds, I talk about management fees for a second. Unlike other management fees, I don't charge any other expenses to you. So in that management fee, all tax, all legal, all compliance, all staff fees, all of the management of the company of the fund is covered in there. You don't get anything else passed to you as if investors. The assets themselves are the only expenses, never anything else. And I promise you, I will never come looking for anything else. The PPM makes it very clear it's all on me if things go bad. Great question though, Todd. It'll be a really good problem to have, is what I would say. If we get to 10 and Honest Mischief is still kicking out lots of cash, I promise you we'll be happy to leave the fund open. Great. Well, super. And thank you all. Make sure you log into the portal and have a great evening. And I look forward to having you all on Fund 7.